Hey everyone, and welcome to our First Home Buyer series of webinars. We're actually doing a three-part series to educate first home buyers on things that they don't know, things they may not be aware of, and basically just give them a bit of an idea on what you might need to look out for to be able to make the process a whole lot simpler for yourself. So welcome to our First Home Buyer series. At the end of this webinar, which is part 1 of 3, we will have on the right hand side of your screen a download link for a bit of a checklist on things that we go over today that can help make the process a whole lot easier for you. So to get started today, we'll be looking at probably quite a few different things and parts of the process and ways that we can make this a whole lot easier for you. So again, it's a 3-part series, and this is part 1 of 3 for this webinar. So today is how to prepare to buy your first home, what to look out for, and to go through the checklist with you so that you have an understanding of the different parts of the process when buying a home, what to look for, and what you might not know. Our goal here is to basically work towards helping Kiwis into their first homes. We deal with people who are buying their first homes on a very, very regular basis. We're experienced with the process and obviously want to help you to be able to make that jump onto the property ladder and get an understanding of what the process is like and make it hopefully not as daunting as what most people tend to find it. So as I mentioned, part 1 is basically trying to figure out what you need to do first and in sequence to be able to get yourself from maybe where you are, being a little bit unsure, to a point where you've settled and you are in your first home. So I'll walk you through the process and steps of that today. So the number one most important thing, I think, when you are looking at purchasing your first property is getting an idea on what you can afford. The reason that's important is you don't want to be in a situation where you maybe go out to the market, you start looking at a few properties and then find out that either you are in a situation where maybe you can't afford a house that you thought you could, or alternatively, you're in a position where maybe you thought you were more restricted than you really are. And so potentially you're holding back, maybe buying a house that's not as nice as you'd like, but you're only doing that because you think maybe you can't afford more, when in reality, a lender would be potentially happy to lend that sort of money to you. So finding out what is possible would definitely save you a whole lot of time and also point you in the right direction in terms of what is possible and getting a really good understanding of your financial situation and what is open to you. So in this particular part of the process, what we recommend doing is having a chat with a mortgage advisor. The reason we recommend going to a mortgage advisor is that there's quite a lot of things that have changed in the finance market when you're looking for your first home loan, and understanding the process or working with someone who does can make your life a whole lot easier. So starting off, contacting a mortgage advisor would be a great place to start. One of the other benefits of working with an advisor is we work with multiple different lenders. So if you go down to your local bank, they can only offer you products that that particular bank has to offer. Mortgage advisors are great because they're not biased. They don't only offer one particular set of products. They can look through the entire market and figure out what might be best for you based on either what the bank's products are and what they're offering. Now that could come down to the way that they structure their loans. It could come down to the pricing that they're willing to offer and how they do things. But predominantly it'll come down to your financial situation. Some banks are better than others when it comes to different types of income. So for example, if you receive a bonus or a commission, if you are self-employed, all of these sorts of things can factor into the decision on which bank to go to. If you only go to your existing bank, then in many cases, a lot of that part of the process is actually not thought about, and finding the right lender for you is very, very limited in that space because it really just comes down to what's on the table at the time. So a mortgage advisor doesn't have to set you with one particular lender. They can use anyone in the market, assuming they are accredited with those lenders, and they can find the right space that fits for you when it comes down to looking at mortgage lending. One of the other parts of the process which people are often surprised about, but it's very, very worth knowing, is that for the most part, mortgage advisors' services are free. I will say that there are other little hooks to that which you need to be aware of. But for the most part, if you're going through a main bank and you are looking to buy your first home and live in it for, let's say, the foreseeable future, then in many cases the service is going to be free for you. There are other little things to know, so if you do have any queries about how mortgage advisors are paid, feel free to get in touch with us and we can go through that with you on an individual basis depending on your plans. So, as I said, working with an advisor is great because they have the expertise and they've done this process multiple times. They're free for 99.9% of people, and you're also in a situation where you have access to the entire mortgage market and can actually work with someone who's got your best interests at heart rather than just simply selling you their own product. So start by figuring out how you can afford, and in order to do that, have a chat with your local mortgage advisor. The next part of the process is trying to actually go through the mortgage pre-approval application process. So what that will involve is, once you've had a discussion around things like, what it is that you're looking to do in terms of maybe your purchase price, what your plans are, when you're going to move into the property, when you want to try and actually make the purchase happen. As things progress, your mortgage advisor will set you up with a few steps to take to be able to get into a situation where you can formally apply to a lender. How that works is you'll fill out an application form, which you usually would have gone through at the prior stage in step 1, where you determined what you could borrow. That would give us information on your financial position, and it would include things like what deposit you have and your savings, whether it be KiwiSaver, just normal savings, any gifts or anything like that to consider. And then it'll also include things like your personal income and how your employment situation currently sits. Once we've had a chance to look through all that, we would usually send you a list of what we need to be able to approach a bank. For the most part, what that includes is things like a privacy declaration, which allows us to send your information to a bank. It'll include things like your pay slips, or if you're self-employed, it might be your tax returns or your financial statements. And then for pretty much every borrower, it's things like your bank statements, proof of savings, proof of eligibility to withdraw your KiwiSaver, and potentially other documents that might be unique to your situation. So if you've got credit cards, if you've got car loans, the lender might want statements for those sorts of things as well. Once you've sent all of that stuff through to your advisor, they would package your application up in a way that is most applicable to the lender that they're going to, and make sure that you're seen in the most positive light to be able to have the best chances of getting an approval which was related to what you would have discussed as possible for you, and also aligning that with your goals. So let's say, for example, you had an initial discussion and found out you could borrow 850k, but you didn't actually want to borrow that amount of money, and instead you decided that you wanted to maybe get approved for up to 750. The advisor would work with you based on what you're trying to achieve and get you approved for that 750 figure so that you are ready to go. With the actual application process, once it's submitted and is sitting in the queue with the bank, your application would sit with many others out there who are also in the queue to get assessed. Depending on the urgency of the application, so if there's a looming auction date, let's say coming up this weekend, or you've signed a property up and you have X number of working days to be able to get finance, then those applications tend to be prioritized over and above other standard applications where people maybe haven't found a property yet or don't have urgency. So be aware that that process can take a little bit of time depending on the situation. But what will happen is a lender will pick the application up, they'll look through everything that's been provided by the mortgage advisor and yourself, and they will go through to make an assessment on what they see. If there's anything unusual or they have queries about anything, then they would usually get in touch with the advisor to ask questions, which would then obviously the advisor would revert back to you and try and figure out or get to the bottom of any queries that the lender has. Assuming things are all straightforward, then the next time you should hear from your advisor hopefully will be a piece of paper which is a formal loan approval. So that loan approval or pre-approval is basically a letter that says, hey look, we as a lender are happy to lend to you. We're happy to give you this amount based on the information that you've told us. And usually those are valid for anywhere between 60 and 90 days depending on the lender. Now, at that point, basically you're in a position to be able to go shopping. Some things to be aware of is that the process overall can sometimes be quite difficult, and so having an advisor to walk you through some of those steps can be really beneficial because you find that the process is less overwhelming. So looking through the process and getting to the other end probably gets you to a point where you're a little bit more relieved. You know exactly where you are in terms of maybe what you want to spend, how much you can borrow, what is affordable, and also are now in a position where you can put the finance part behind you, which can often be quite stressful, and go out there and start looking for properties that might be suitable to the goals that you have, and also to the budget that you now know you are able to go shopping within. So I think it really comes down to understanding that part is probably the most primary part of the buying process, because you want to know what you can actually look at doing before you go out and start doing it. The next part is understanding what sort of properties you might be looking at, and doing your research to understand properties that might be suitable to you. You want to find out the market itself. You want to look at things like the suburb it's in, what parts are relevant to your particular situation. So do you want a 1-bedroom home? Do you want a 2-bedroom home? Do you want a property in X neighborhood or Y neighborhood? Are you close to certain things like schools, shopping malls, transport, hospitals, those sorts of things? Get a bit of an understanding of the area, and then also look into additional costs and getting a bit of an understanding of what it takes to be a homeowner. So when you're looking at some properties, they have different aspects that might be important to them. You might have things like an apartment, which has body corporate fees, in addition to things like council rates and stuff like that, or a standard house, which might just have the rates and insurance. So you'll want to get an understanding of the different costs that are applicable when it does come to mortgages, and then also understand how the changes in the price are affected by these sorts of things. So sometimes the price of a particular type of property can be affected by the certain benefits or pros that it has around it, or the certain cons. So if you maybe are close to a bad neighborhood, or power pylons is a common one, or things like that, then it might have an influence on the price, and you might be able to get a better deal if that's something you're interested in. Or alternatively, you might have to pay slightly more for a property that is on, let's say, a full section or in a really, really good school zone. So understanding these sorts of things when you are doing your research is important, because that will help you to understand why one house might look and feel a lot like another one, but be quite different in terms of the price that you actually have to pay for it. So just be aware that those sorts of things and what we call property fundamentals can have huge influences on what you actually end up paying for a property. And the best thing to consider and understand is you want to try and pay as little as possible for a particular property that you can, and that all comes down to your ability to negotiate and the knowledge that you have around the particular buying process. Something else which is also really, really worthwhile is if you're looking for homes, most people tend to look on websites like Trade Me Real Estate. Both of those websites actually show when the property was originally listed. So if you do a bit of research and a little bit more digging, and you find out that a property has been on the market for an extended period of time, then you might be in a situation where you could make a slightly lower offer on a property that maybe 6 months ago you may not have had a chance to get, because there were just so many people interested in it because of the way the market was. So doing research and understanding things like that, having a chat to the agent and going, okay, well, why didn't this sell? Or, what's been the feedback from other buyers? Why has it taken so long? What's the problem with it, and why is it on the market for 8 weeks and not selling? Or did you take this property to auction, and is it then something that didn't sell at auction? What was the reserve? And just understanding all of that sort of stuff before you actually go through and formally make an offer. The reason why, as I said, is it all ties back to the final offer that you make. And if you can save yourself $10,000, $20,000, $50,000, then that should absolutely be your goal as a buyer. Obviously, the vendor has a different motive to you, and they want to sell it for as high as they can. But at the moment, as a buyer, I think you're in a situation where, with the way the property market is currently, you are probably in a stronger situation than you were, let's say, 6 to 12 months ago, because the market is not as hot, and you have the ability to take your time when you are looking at properties, have a little bit less competition out there, and find a deal that's probably most suitable for you. So when you get to the point where you have done your research and you are ready to potentially make an offer, we recommend at this point it might be worth engaging with a solicitor, so that you're in a situation where they know that, number one, they're acting on your behalf, and two, that it's possible that in the reasonably near future you might come to them with a sale and purchase agreement and say, hey, look, this is a property that I'm interested in buying, and I might need your help. We can recommend some solicitors who you can work with, and in a later part of this webinar we'll actually introduce one of the solicitors we work with who we've found fantastic. So where a solicitor might come into the process and might be extremely valuable to you is around things like understanding what is on the sale and purchase agreement, which is a legal document. So it can tell you things like if there's any issues with the title, what you are actually buying, i.e. How many bedrooms, how many bathrooms, what's consented, all of that sort of stuff your solicitor will be able to make you aware of. Something else that they're really, really crucial for is the withdrawal of KiwiSaver, if you've got KiwiSaver funds to go towards your deposit, and also first home grants if those are applicable to you. So getting a solicitor on board reasonably early is going to be crucial when it comes to the overall buying process, but particularly when you are making an offer, because you want to make sure that you know what you're doing. Another few things to probably look at when you're actually going through this part of the process and actually visiting open homes and doing things like that is deciding whether or not you are wanting a building report. So certain kind of properties often tend to have more risk than others. One that comes to mind, for example, is plaster properties. Those often have a stigma attached to them, and people often will immediately think they're leaky, and for good reason, many of them are. But having a building report might give you some certainty around the nature of a property. If it, looks leaky or smells damp or wet, if there's mold everywhere, or even if there's unconsented works and things like that, then your building inspector might be able to help you understand any problems with the property and anything maybe that looks out of place. Something else, again, that I touch on is understanding the local area and what's around. One key thing you'll need to understand when you're buying your first home is that it probably won't be your last. And so what you want to try and consider, although it might not be your main consideration, is after you look at purchasing your first home, at some point in time in the future, you may be looking at selling the property that you are now about to buy. So you want to try and look for something that may be attractive to someone like you who might be buying that property a few years down the track. The reason that's important is if in the future you do look to sell it and then move into another property, whether it be upsizing or moving away to a different city or something like that, being in a position where you can have an attractive property to a potential buying market means that hopefully you can get the top dollar for your property at that point in time. Something else to be aware of is that sometimes you might want to consider getting a valuation on the property. So for the most part, the only time you'll be required by a bank to be able to get a valuation would be when it comes to a construction or a new build type loan. So if you're buying a property that, let's say, doesn't have code of compliance yet, or you're doing a land and build package, then a bank will definitely require a valuation. And another time is if you have an over 80% loan. So if the loan amount is more than 80% of the value of the property, then often a bank will require a valuation. Other than that, for the most part, valuations aren't 100% necessary. There are two other times where they can be required. One is if there is a private sale. So if there's no real estate agent involved at all, and let's say you're buying the property off your landlord directly, off your parents or friends or someone like that, then a valuation may be required. Also, in addition to that as well, if you've bought the property for significantly different amount to what it may be worth when you compare it with other comparable properties. So let's say you buy a property for 500 grand, the bank runs some checks on the property and they think the property is worth 1.5 mil. They might ask for a valuation to get an understanding of why this is happening. And it could be, in that scenario where you've purchased it for a lot less, or it could be in the alternative scenario where the property is worth 500k, but you're trying to buy it for 1.5 million. So anything like that sort of rings alarm bells to a lender, and they want to go, okay, well, let me get a valuation. That tells them what the property is worth based on comparable sales, but also it includes a description of the property. It includes an understanding of whether the property has code of compliance, and also any other things that might come up in photos, because a valuer would actually come by and take photos. So other than those scenarios that I mentioned, it's very unlikely that a bank is going to sit there and go, you have to get a valuation. But that might not mean that you're in a situation where you don't want one. You might decide to get a valuation because you're not 100% sure what a property's worth. You want to make an offer that's fair, but you also don't want to make an offer that's maybe more than you need to spend for the particular property that you're looking at. So if that's the case, you can go down the path of actually contacting a valuer and working with one of the reputable valuation firms out there. However, if you are looking at doing it for one of the reasons I mentioned before and the bank is making you, then ensure you do go through one of the bank approved channels. And again, this is something that your mortgage advisor can help you with. If you're looking at getting a valuation for your own purposes, then basically all you need to do is contact a reputable valuation firm. Make sure you find someone who's independent to the vendor. So don't, for example, take their valuation and assume it's accurate. Maybe we'll pay to get your own. But if you are doing it for one of the reasons I mentioned and a bank is making you get the valuation, then definitely look at working with one of the bank approved valuation systems. So what that would be someone like Velocity or CoreLogic. They are both independent outfits which most of the larger reputable valuation firms belong to. So work on figuring out which option or avenue might be best for you and doing it according to what might be required based on your lending requirements. So then it really comes down to obviously making that formal offer and hopefully getting it accepted. If it is accepted, then usually you have a period of X number of working days to be able to finalize your financing needs or any other checks that you wanted to do. Things like the valuation or like the building report that I'd mentioned. Once you get to the point where you have had that offer accepted and you're happy and you're good to go, then it really comes down to working with your mortgage advisor to select a loan structure that suits you. So there are various different types of loans, and you'll want to get an understanding of what those are and what might suit you best. And your mortgage advisor can really help with this part of the process and give you an understanding of the pros and cons of each, and also, why they might be better for your particular situation and goals. So at this point in time, usually you'd get in touch with your advisor again. Obviously, they would be aware of the process because you've now committed to a property, and so they'd know roughly where you're at and basically can arrange a time to have a discussion around what to do when it comes to structuring your mortgage appropriately. Again, this is going to very, very much be aligned to the goals that you have and understanding those, and then getting an idea on whether you should fix part of your mortgage or all of it, have a portion of your mortgage maybe that's floating, and also give you a bit of an understanding of what your repayments would be and how this would fit into your budget. What sometimes is quite common when it comes to the structuring process is that people will immediately look for the lowest interest rate, which often can be the fixed 1-year rate, and then they assume that that's the best rate simply because it's the cheapest. That's not always the best strategy, because over time, especially if you're going to have a mortgage for, let's say, 30 years, over time your mortgage interest rates can change. So it might pay, particularly in an interest rate market like the one we've got where rates are increasing, it might actually pay to fix maybe for a longer term and get a bit more certainty, although you have to pay for it a little bit up front by having a slightly higher fixed rate, rather than just, let's say, fixing the 1-year rate and then hoping for the best in 12 months' time. Not necessarily saying that's the wrong strategy, but it's just about understanding what your plans are and what your goals are and working through that with you. The next part, once you've finalized your loan structure, is basically taking a look at the paperwork, getting an understanding of the documentation that describes entirely to you what a mortgage is and also all of the things that you've agreed to under the mortgage contract. So the loan will formally get structured by your mortgage advisor. What will then happen is they will send that structure through to the bank, who will work through the process of generating formal loan documentation, which will get sent to your lawyer. The loan documentation is basically the legal terms and conditions for the loan, and also a mirror of the structure that you've requested and what you've agreed to. So that might be things like the repayment frequency. So if you want to pay your loan fortnightly or monthly, it'll be the loan type, so whether it's principal and interest or interest only. It'll be the fixed rate you agreed to or the floating rate, and comments around how that works, and all of the other things that you need to be aware of in terms of the obligations with your mortgage. The person who goes through that with you is your lawyer, and basically they sit you down, explain everything, ensure that all the documentation is right as per the structure that you agreed, and also get an understanding of the fact that you understand what is in these documents and what you're getting yourself into. At that point, everything is then signed, and your lawyer will send the documentation back to the bank. You would usually do this at least a few working days before settlement, assuming everything was going well. In some cases, we have had situations where people have left this to the very, very last minute and signed the day before. That's absolutely fine, but just keep in touch with your lawyer, and whatever they tell you that you need to do in terms of timeframes is what I'd recommend doing. Once that's all sent back to the bank will wait until settlement day. Let's say you signed the documentation on a Wednesday and settlement day was on Friday. Friday morning, your lawyer would request funds from the bank, and hopefully at that point have your funds as well. So the funds from you would be your deposit, and the funds from the bank would of course be the mortgage. When they have all of those funds together, they would then transfer it over to the vendor's lawyer. The vendor's lawyer would hold the funds and they would transfer the title of the property over to you. At that point, the transaction is complete, the property is yours, and you've now got the mortgage in place and ready to go to move forward. That's probably the most exciting part of the process, because you've officially become a homeowner, and you are then in a situation where you can go away, celebrate, and obviously enjoy the new home that you can move into. So later that day, usually the agent is in touch with you to hand over the keys, finalize any questions that you've got, and obviously, see you move into the property that's now yours. So overall, it's really probably a simple process, but there can be things along the way that tend to make it more complicated than it needs to be. So what you want to be doing is getting in touch with someone like a mortgage advisor who does this every day for a living. You want to be with someone who has experience going through the process. They can help you figure out, obviously from the get-go, knowing what you can borrow and actually working to get you an approval for that amount. You want to then obviously enjoy the journey, park aside the finance piece, and just start to look at houses that might be attractive for whatever your goals are, and getting a bit of an understanding around that. Once you get to the point where you found the house you love, you want to finalize the loan structure, obviously meet with your lawyer for any questions that they may have, or any questions that you may have, and go through the loan documentation with them so that you understand everything that you need to know about the mortgage and what is required of you. Mainly all that is making sure you pay your mortgage on time and you look after the property. Provided you do that, everything should be good to go, and you've really gone from not really knowing too much about the process to actually going right through the process, experiencing it yourself, and finally being in your first home. So thanks a lot for obviously paying attention to our first part of our webinar series. We look forward to seeing you again in part 2. And as I said, please feel free to get in touch when it comes to the mortgage process. We'd love to help, and we work with first home buyers all the time. Thanks.